You're listening to The Intellectual Investor, episode number 73. It's not just Amazon's fault. Written by Vitaly Katsenelson and read by Elliot. To read this article online, or to listen to more episodes, visit investor.fm. To learn more about Vitaly's investing firm, IMA, go to imausa.com. It's not just Amazon's fault. Retail stocks have been annihilated recently, despite the economy eking out growth. The fundamentals of the retail business look horrible. Sales are stagnating and profitability is getting worse with every passing quarter. Jeff Bezos and Amazon get most of the credit, but this credit is misplaced. Today, online sales represent only 8.5% of total retail sales. Amazon, at $80 billion in sales, accounts only for 1.5% of total US retail sales, which at the end of 2016 were around $5.5 trillion. Though it is human nature to look for the simplest explanation, in truth, the confluence of a half dozen unrelated developments is responsible for weak retail sales. Our consumption needs and preferences have changed significantly. 10 years ago, we spent a pittance on cell phones. Today, Apple sells roughly $100 billion worth of iGoods in the US, and about 2/3 of those are iPhones. Apple's US market share is about 44%. Thus, the total smart mobile phone market in the US is $150 billion a year. Add spending on smartphone accessories, like cases, cables, glass protectors, etc., and we are probably looking at $200 billion total spending a year on smartphones and accessories. 10 years ago, before the introduction of the iPhone, smartphone sales were close to zero. Nokia was the king of dumb phones, with sales in the US in 2006 of $4 billion. The total dumb cell phone handset market in the US in 2006 was probably closer to $10 billion. Consumer income has not changed much since 2006. Thus, over the last 10 years, $190 billion in customer spending was diverted towards mobile phones. It gets more interesting. In 2006, a cell phone was a luxury only affordable by adults. But today, 7-year-olds have iPhones. Our phone bill per household more than doubled over the last decade. Not to bore you with too many data points, but Verizon Wireless's revenue in 2006 was $38 billion. Fast forward 10 years, and it is $89 billion, a $51 billion increase. Verizon's market share is about 30%. Thus, the total spending increase on wireless services is close to $150 billion. Between phones and their service, this is $340 billion that will not be spent on t-shirts and shoes. But we are not done. The combination of mid-single-digit healthcare inflation and the proliferation of high-deductible plans has increased consumer direct healthcare costs and further chipped away at our discretionary dollars. Healthcare spending in the US is $3.3 trillion, and just 3% of that figure is almost $100 billion. Then there are soft, hard-to-quantify factors. Millennials and millennial want-to-be generations, speaking for myself here, don't really care about clothes as much as we may have 10 years ago. After all, our high-tech billionaires wear hoodies and flip-flops to work. Lack of fashion sense did not hinder their success, so why should the rest of us care about the dress code? In the 90s, casual Fridays were a big deal. Yippee, we could wear our jeans to work. Fast forward 20 years, and every day is casual. Suits? They are worn to job interviews or to impress old-fashioned clients. Consumer habits have slowly changed, and we now put less value on clothes, and thus spend less money on them, and more value on having the latest thing. All of this brings us to a hard and sad reality. The US is over-retailed. We simply have too many stores. Americans have 4 or 5 times more square footage per capita than other developed countries. This bloated square footage was created for a different consumer, the one who in the 90s and 2000s was borrowing money against her house and spending it at her local shopping mall. Today's post-Great Recession consumer is deleveraging, paying off her debt, spending money on new necessities such as mobile phones, and paying more for old ones such as healthcare. Yes, Amazon and online sales do matter. 10 years ago, only 2.5% of retail sales took place online, and today that number is 8.5%, about a $300 billion change. Some of these online sales were captured by brick-and-mortar online sales, some by e-commerce giants like Amazon, and some by brands selling directly to consumers. But as you can see, online sales are just one piece of a very complex retail puzzle. All the aforementioned factors combined explain why, when gasoline prices declined by almost 50%, gifting consumers hundreds of dollars of discretionary spending a month, retailers' profitability and consumer spending did not flinch. Those savings were more than absorbed by other expenses. Understanding that online sales, when we say this we really mean Amazon, are not the only culprit responsible for horrible retail numbers is crucial in the analysis of retail stocks. If you are only solving who can fight back the best against Amazon, you are only solving for one variable in a multivariable problem. Consumers' habits have changed. The US is over-retailed, and consumer spending is being diverted to different parts of the economy. As value investors, we are naturally attracted to hated sectors. However, we demand a much greater margin of safety from retail stocks, because estimating their future cash flows, and thus fair value, is becoming increasingly difficult. Warren Buffett said that you want to own a business that can be run by an idiot, because one day it will be. A successful retail business in today's world cannot be run by an idiot. It requires Bezos-like qualities: being totally consumer-focused, taking risks, thinking long-term. And one more thing. I am not a journalist or reporter. I am an investor who thinks through writing. This and other investment articles are just my thinking at the point they were written. However, investment research is not static. It is fluid. New information comes our way and we continue to do research, which may lead us to tweak and modify assumptions, and thus change our minds. We are long-term investors, and often hold stocks for years, but as luck may or may not have it, by the time you read this article, we may have already sold the stock. I may or may not write about this company ever again. Think of this and other articles as learning and thinking frameworks, but they are not investment recommendations. The bottom line is this: if this article piques your interest in the company I mentioned, great. This should be the beginning, not the end, of your research. Thank you for listening. This and other investment articles by Vitaly Katsenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaly's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.